TipRanks presents TIpTalks, the only podcast where you can listen to the insights, discover the trends, and power up your investment portfolio. Investors, welcome back. I am incredibly excited to have here with me today Meyer Shields, an analyst from KBW. He is one of Wall Street's finest and ranked here at TipRanks number 389th out of over 8,500 analysts. Now, for those of you joining me for your very first webinar, my name is Ari Gutman. Of course, you can catch these webinars every single week. From time to time, we have the greatest of privileges to have an analyst like Meyer join us. So, Meyer, I first want to say thank you so much for coming on with us and joining us for today's webinar.
Oh, absolutely my pleasure. Thanks so much for the kind thoughts, and it's great to be here.
Of course, I'm super excited. I know many of our viewers are also incredibly excited, because every single week on these webinars, what we really try to do our best with, right? TipRanks is known for rating analysts, taking a look into hedge fund activity and insider trading. We have a plethora of tools, but what we always try to do on a week-to-week basis is try to grasp a good understanding of the economic backdrop. From that economic backdrop, then we want to dive into sectors, right, that may be worth our watch, at least for the time being. And then furthermore, try to do our best to look into some stocks. Now, it's great to have an actual analyst on with us with such experience like you have. But with that being said, I want to turn it over to you just to give a brief introduction to who you are, your background. I mean, I know you've had years of experience on the street and, of course, covering the markets, U.S. markets, Canadian markets, specifically covering financial and insurance companies. But if you could give us a little bit more of a background, I'm sure you could do a better job than I can.
Okay, absolutely. Let me start. So, I graduated from the University of Toronto in, December of 1992 with a degree in actuarial science. I got into that accidentally. I started off pre-med and was not getting into any medical school as anything other than a cadaver. And someone suggested this as another career opportunity. And I actually worked as an actuary for 8 years at all times for subsidiaries of Zurich, at the time Zurich Insurance, now Zurich Financial, which was and is an international insurance entity. My experience, both as an actuary and as an analyst, is entirely in the property and casualty space. And that would run everything from cars and homes for individuals to medical malpractice to large corporate D&O. So the entire spectrum of property casualty insurance. But I've been focusing as an analyst really since 2000. So about 23 years. Once upon a time, that was a long time, not anymore, covering the space, really everything from insurance brokers, personal insurers, commercial insurers, reinsurers. And that, I think, is probably the best summary of my professional experience.
There we go. Meyer Shields in a nutshell for all of us out there. I want to go right in now to the stocks that you're covering, because what's particularly interesting for me, actually, you just shared a little bit about it, right? Your background, or at least you started off, it sounds like, looking to go medical, and then you landed on Wall Street. I'd love to know a little bit about how you decided to make that pivot and land yourself on Wall Street. And then if you could share a bit about, what is it about these two industries? Of course, it sounds like you have the industry expertise when it comes to both spaces, right? Both industries. But today, I feel like there's just so much talk about tech. And for a lot of investors out there, I feel like there could be so many exciting opportunities in tech and elsewhere. What is it about the financial space and the insurance space that keeps you hooked on these two industries?
Okay, so let me see if I can answer that well. In terms of what we find to be interesting right now, there are a number of very tech-focused insurance companies out there. That's absolutely true. They're not really disrupting the industry. I think we're at a point where if you look at the legacy insurance industry, there are a number of really well-established, very capable companies that have the resources to invest in technology. So while you've got some pure play, we call them insurtechs, not very creatively, there are a lot of incumbents worldwide that have been investing heavily in technological capabilities, and they've got the legacy information and customer relationships and distribution relationships. A lot of insurance is sold through independent third parties, and it's been hard for the insurtechs to really disrupt many of the incumbents. Now, the insurance industry, I would say, if we looked at it in its entirety, is probably a little bit behind in terms of adopting technology, but there's a wide spectrum. There are companies that are small and don't have the resources and will be behind probably forever, or at least as long as they can hold on. But then there's some major companies, and the one I'm thinking of as I say this is Progressive, which has always been an innovator and a leader in terms of using technology. It sounds ridiculous now. They're one of the first companies to say, hey, we should use computers in the insurance business. But at the time, it was a massive investment in massive vacuum tubes. And they have maintained that leadership in terms of their analytical prowess. And therefore, we talk about, let's say, digital insurance distribution, they're absolutely a leader when it comes to that. So there are certainly some of the shinier aspects of technology that even the legacy industry uses. And the legacy industry, again, has tremendous amounts of information. And information in insurance is the lifeblood. It's not a perfect indicator, but if you're trying to figure out what should we charge this person for his or her car insurance, what should we charge that doctor for his or her medical malpractice insurance, you need, I think, to have a vast amount of data that you can then adjust, taking the past and using it as a prologue for the future. So from that aspect, the technology side is there. And what else is interesting about it? Again, it's from the outside, it's not the most fascinating sector, but almost anything that goes on, and I hate to say this, anything bad that happens in the world touches on insurance. And we've gone through a number of recent significant tragedies, the earthquake in Morocco, the wildfires in Hawaii, the flooding in Libya, not so much. There just doesn't seem to be insurance exposure there. But as a concept, flooding is a material risk that has insurance. So being able to review a sector that really does, at least in most opportunities, help people recover from bad things that have happened to them. There's always something going on. And in many cases, there's actually positive attributes there. And I'm saying this because insurance gets a bad rap, right? For most people, insurance is either a bill that you pay and get nothing for, or you interact with them when something goes wrong. So it doesn't have a lot of positive connotations. But the truth is, if you take a step back, and I sound a little bit like a shill, I recognize that right now, the insurance industry really does broadly say, we're going to remove that uncertainty from a financial standpoint from you, and that helps with planning a lot. So let me stop there. But that's really what keeps me interested, is that there's always something going on. Again, sometimes it's in the context of something bad happening, but there's enough development and innovation in the insurance industry to keep me interested.
Sure. No, you hooked me with a lot of the development, right, to keep you interested, because right off the bat, I think about a company like Lemonade, right? Like a couple of years ago, Lemonade came out of what I feel like was left field. It was more of like one of those trendy stocks, but we have a lot of those insurance companies that are out there. They've been around for decades. And, although Lemonade was a very exciting opportunity, a lot of investors jumped on, the retail investors jumped on. What that I think shed light onto is that there are a lot of opportunities for growth within the industry, specifically when it comes to AI. I'm curious, in your perspective, is that same growth module, if you will, there for, say, the financial sector plays as well?
So I'm much more familiar with the insurance side of things, so I couldn't speak broadly. But when we look at insurance as at least a model for that, there are a ton of insurance companies, and that's whether we're talking about the underwriters or the insurance brokers, and the range of capabilities is immense. Now, I don't know what Lemonade would say. I would say they'll probably have a tough time dislodging the top 2 or 3 car insurance companies, or pet or health. I mean, pick something like that. But could they dislodge the smaller companies? I think there's an argument to be made for that. And if you do that for long enough and you continue to invest, and what you're doing is building the scale that you have, then that sort of opportunity exists. And I have to think, looking at other financial institutions where I have little expertise, there do seem to be, again, the same number or differentiation in capabilities and resources. So I suspect the answer is yes.
Sure. Interesting. And the follow-up question I have for you, right? And I start to think, especially when it comes to insurance, I love how you shared the only real time we start to think about insurance, we get the bill. But for me as an investor, and I'm sure for you as an analyst, or if you're investing right personally as well, what I'm always thinking about is the business model of a business in and of itself. And something that we often talk about on these webinars is beginning to look at businesses, not just as an investor, right, but really as a business owner. After all, an investor is going to place that investment into a company. They should know how the business operates. And what's particularly interesting with insurance company is the business model. I'd love to know from your perspective, what makes insurance companies more, I'll use the term moat worthy, if Warren Buffett like, than say tech or any of these other sectors that could actually help us during economic uncertainty?
So it's a really good question. And we cover Berkshire Hathaway, so I'm very familiar with Warren Buffett's, let's say, enormously successful focus on identifying companies with moats. And I would put Geico in that category, for example, owned by Berkshire Hathaway. It can differ enormously based on what they do. So I would start first and foremost with data, which is not perfect. We're going through this weird period now in, let's say, car insurance, where we're seeing much more volatility in the inflation rate for claims than we've normally seen. So data is not perfect, but it's better than any alternative out there. It's much harder to simulate that level of information and then come up with an appropriate price for the insurance that you're going to sell. And for that matter, coming up with an appropriate estimate of claims that you've incurred but not paid, which is another enormous financial metric for insurance companies. So the biggest moat that you can have is the amount of data that you have. That said, there was a time up until, I'm going to say 2017, when AIG was a massive commercial insurance company with tons and tons of data, but not a good strategy. And it was not making money for itself or for its shareholders. So that's a good place to start, but you also have to have an intelligent strategy, which will vary based on what you're trying to do. Your geographic location, the lines of business you focus on, how you sell your products, the skill set of the people making the decision. Let me try that again. Decisions. Should we underwrite this risk? Should we not? So there are other elements to it. So again, I'll start with the data, but the ability to analyze it. And here's the trickiest part, to actually make judgments on the basis of that data. What should we do, given that this is what we're seeing in terms of pricing trends and loss cost inflation trends and the frequency of claims? And that's really, really hard to do. So all of those matter. Now, when we step outside our perspective and we look at it from the perspective of the companies, brand names matter too. And we touched on that with Geico. Geico has been a brilliant advertiser for the longest time. And whether it was the caveman campaign, which seems to have run its course, the 15 minutes can save you 15% or more, these are phrases that resonated with people for the longest time. And they're very familiar with Geico because of that. So even if car insurance policies are largely commoditized, they stand out. They have a brand that people know, and they have scale that helps people save money with them too.
Sure. No, that's fascinating. And something, again, we don't think about, I feel like, when it comes to insurance, because oftentimes, and I can tell you firsthand, right, a lot of our users across TipRanks, when I'm meeting with them for what we call customer experience sessions, I hardly ever hear any of our investors sharing, I'm heavily invested or heavily interested in the insurance industry. And here's why, right? I always hear tech, that's a classic. And then I always start to hear like the classic household names, right? Our Johnson and Johnsons and Proctors and Gambles and, the alike. Now I'm curious to know, because right now I feel like we're in a very interesting economic environment. And I feel like the past maybe 3-4 weeks have really been hearing this term, a Goldilocks scenario, right? In the news where inflation's been coming down, the labor market's still robust. Will the Fed hike rates? Will they not hike rates again? As of this recording, inflation just came in at 3.7%. And again, as of this recording, we're going to have another update out of the Federal Reserve in regards to their FOMC meeting, if they're going to hike the rates. But generally speaking now here, and I guess stepping back briefly, I just want to ask you your opinion here on our economic backdrop and looking ahead, say, perhaps just the next 90 days, closing out 2023. Can the insurance industry, if we begin to look there as investors, really yield us a good return? Or is it going to take time, right? Is that going to take another 6 months, year out, a long-term investment as opposed to the shorter term?
So the answer is yes. I think even in the shorter term, there are a number of subsegments of the insurance industry that are poised to inflect. And let me hit on two of them really quickly. The first is car insurance, right? Car insurance has been this bizarre roller coaster ride, right? We went into COVID and all of a sudden nobody was driving. So
Sure.
car insurance companies were making a tremendous amount of money. Now they provided refunds or rebates to their customers to reflect that in part, but 2020 was the most profitable year we'd ever had. And then we left that sort of really quickly going from, hey, nobody's driving to supply chain disruption. So now the cost of used cars, which is a major claim cost or expense for insurance companies, that was skyrocketing. And it turns out, I can't explain this, but people learned to drive much worse during COVID, and they've maintained those habits afterward. Is it handheld device distraction? I don't know. Speeding, you name it. But people are driving much worse. It's a weird thing. So we went from immense profitability to terrible unprofitability. And we're really on the cusp of the insurance companies finally starting to catch up with it, where their underwriting results are no longer going to be getting worse on a year-over-year basis. And that's the first step to getting back to adequate returns. And I think from an investor standpoint, that's actually is an important inflection. So I think that's something that's coming up fairly soon. A second one in a different space is reinsurance. There's a major reinsurance conference every year, the week after Labor Day in Monte Carlo. So we just got back from that. And reinsurance has this really tight schedule. The single most important day is January 1st. The message we got at Monte Carlo is that the reinsurers, who are not colluding, but all have, I think, similar approaches, saying we'd gone through a long period of time where reinsurance was just too cheap. And now there's this level of discipline where they're saying we started charging an appropriate level for reinsurance in 2023, and that will be maintained in 2024. And I think as that message becomes clarified, and as we look at the earnings associated with this new element of discipline pricing, whether it's when companies report third quarter earnings, late September, early October, whether we start looking forward to the January renewals called 1/1, I think we're going to see impressive performance there because the sector will, I think, and again, I should caveat that, every day is earthquake season. We're still in the middle of hurricane season, so something could go wrong very soon, hopefully won't. But for the most part, it looks like they're going to generate good earnings and have really good prospects to do that again in 2024. And this is a period of time where we'll see that. Besides that, obviously, there are a number of high-quality companies that will generate solid returns overall. There, I don't know if we're going to see a sentiment change, but I think we're poised for a sentiment change, even in the short term, for a couple of sectors in the insurance space.
TipRanks presents TIpTalks, the only podcast where you can listen to the insights, discover the trends, and power up your investment portfolio.
Investors, welcome back. I am incredibly excited to have here with me today Meyer Shields, an analyst from KBW. He is one of Wall Street's finest.